5 a.m. in New York City. Good morning. I'm Tyler Kendall in for Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Oil trading down after rallying to a 6-month high as President Trump gives Iran 15 days to reach a deal. A private credit warning. Blue Owl sells a $1.4 billion portfolio of loans to help pay out investors and markets. So wait the latest PCE data and a possible Supreme Court ruling on President Trump's tariffs. All right, happy Friday. Let's take a look at these markets. Futures pointed higher after we really saw geopolitical tensions yesterday push stocks down. S&P futures up about 0.2%. NASDAQ 100 futures up 0.3%, and small caps up as well, up about 0.1%. Let's also check in on the bond market as we await a flurry of economic data here in the U.S. GDP, also that December PCE inflation report delayed because of the government shutdown. And if you're keeping track, that's the last U.S. government shutdown, not the partial current one that we're in, as it appears Washington is no closer to funding the Department of Homeland Security. On the long end, the 30-year trading at 4.69. On the short end, the 2-year yield at 3.46, and that 10-year yield sitting just above 4.07, up not even a basis point. Now, we also want to check in on some individual stock movers to watch. So let's head over to London and Abir Abu Omar. Hey, Abir.
Hey, Tyler. Let's start with the world's top gold miner. It's not having a particularly good day this morning, down 3% in the pre-market. And this is a two-sided story. So its reported earnings, quarterly profit was good, but it's down on the fact that investors are not looking favorably at the news that it's going to be churning less gold this year, a closure in one of its mines. And so investors not looking favorably, as I mentioned, down 3% this morning in the pre-trade. Moving on to Open Door, this digital real estate company is having a good morning, 14% up in the pre-trade. It's paring down some of the gains from earlier. It was up a little bit more, but it's still up quite a bit, 14.5 now, and it's up on the back of earnings yesterday. Now, this is one of those stocks that is gaining from the AI story. It's repositioned itself to benefit from artificial intelligence, Tyler. And then finally, Moncler, which is already trading in Europe this morning. It's up quite a bit, 11.8% this morning, and it's a good day for puffer jackets on the back of strong earnings and also strong Chinese demand. So that's Moncler for you. Tyler, back to you.
All right, Abir, thanks so much. We'll check in with you later in the program. And coming up this hour, we'll discuss more on credit risks with Cayla Seder of State Street. But first, President Trump warns Iran with an ultimatum.
We're either going to get a deal or it's going to be unfortunate for them. I would think that would be enough time, 10, 15 days, pretty much maximum.
This as the U.S. military deploys a vast array of forces in the Middle East. Joining us now is Bloomberg's Sam Dagger. Sam, thanks for being here. When we're talking about what could potentially tip the U.S. towards military action, do we even know at this point what this White House is looking for when it comes to a potential deal?
I mean, obviously, the nuclear file is front and center, but our understanding, I mean, based on reporting that we've done at Bloomberg, is that the U.S. has been pushing hard also to include issues like Iran's arsenal of short-range ballistic missiles, right? Because Iran still possesses quite a stockpile of that. Israel had destroyed more like the long-range missiles, but Iran still possesses the short-range missiles, which are capable of reaching, U.S. interests, U.S. bases anywhere in the Middle East and North Africa. And the other thing that the U.S. wanted to talk about is Iran's support for proxies, albeit these proxies have been, badly weakened, particularly Hezbollah in Lebanon and Hamas, obviously. But you still have the Houthis in Yemen. You still have the proxies in Iraq. The U.S. wants to put that on the table. And Iran has been resisting very hard and saying, I only want to talk about nuclear. Iran's foreign minister, Arakji, after the talks in Geneva, said, they've made good progress. He said, again, these are his words, that they're in broad agreement over a set of guiding principles. I mean, not much details there. And he said Iran is now working on drafting the framework for the next round of talks. The White House said there was little progress.
Right. I mean, you hear from the Secretary of State, Marco Rubio, saying that those other agenda items really need to be on the table. That then brings us to the question about what is behind this massive buildup of U.S. military assets in the region. Sam, when we're seeing now 2 aircraft carrier strike groups, what is that telling us about those potential options on the table that the U.S. is weighing?
Absolutely. I mean, I can tell you, like, countries here in the region, in the Gulf where I'm sitting in Dubai, I mean, the United Arab Emirates, Saudi Arabia next door, Qatar, all these countries are very nervous. They're saying, well, this buildup is ultimately going to lead to something. It's not just like, build up for the sake of build up, or maybe to use it as pressure or leverage on Iran to sign a deal. As you know, Iran has warned that maybe some of the first steps it would do would be to block the Strait of Hormuz. This is the waterway on the mouth of the Gulf here, through which a quarter of the world's seaborne oil trade passes. And obviously, a lot of the countries here in the Gulf, Dubai is within the range of Iranian missiles. So these countries, particularly the UAE and Saudi Arabia, have kind of preempted all of this, and they've told Iran at the end of January that they won't allow the U.S. to use its territorial waters or its airspace to target Iran. So they're quite nervous, and they're watching and they're seeing this buildup, and they're saying this is ultimately going to lead to something.
All right, a lot to watch. Bloomberg, Sam Dagger. Sam, thank you so much. And turning now to trade, the U.S. and Indonesia have finalized a trade agreement that cuts the tariff rate to 19% and will see Jakarta facilitate the purchase of an estimated $33 billion in U.S. goods. U.S. Trade Representative Jamieson Greer, in a statement, writing, quote, "This landmark agreement breaks down trade barriers while advancing the economic and national security interests of the American people." Joining us now is Bloomberg's Brendan Murray. So, Brendan, what else are we learning about this particular trade deal, and how are we seeing this be part of the Trump administration's bid to counter, say, China in the region?
Yeah, exactly. This deal has been in the works for 7 or 8 months now. The initial framework was announced back in July, so it's taken that long for the two sides to get this over the line. What it does for Indonesia is it brings its tariff on its imports down, so it's competitive with others around the region. And for the U.S., it opens up some markets, agricultural markets, energy markets. It lowers tariff and non-tariff barriers for U.S. exporters to get more access to Indonesia's booming population and middle class. And so both sides seem to have walked away pleased with how this worked out. There were some provisions that were stripped out from the original July framework, the rules of origin being pledge on both sides being one of those that didn't appear in the most recent statement. And Indonesia, importantly, agreed to some digital commerce provisions that the U.S. has been pushing for. So that has been a barrier to broader agreements at the WTO level over the longer term. So that would be a key win for the U.S.
Well, Brendan, we are waiting today potentially for the Supreme Court to rule on President Trump's broad-based IEEPA tariffs. It may rule, it may not rule, but I am curious how this limbo, essentially, when it comes to those IEEPA tariffs, have impacted trade negotiations, like this one that we're seeing inked with Indonesia, but also the fact that we finally got that long-awaited announcement from Japan earlier this week when it comes to which investment deals they're going to fund.
Yeah, a lot of these countries that have been negotiating have been slow walking the talks and trying to sort of wait out the Supreme Court decision to see where the administration will go. If they lose this IEEPA authority that the president has used broadly on most major U.S. trading partners. And so India is one of those ones that's been negotiated now even longer than the Indonesia deal. And it's been one of the toughest for Washington to get over the line. But we understand now that they feel like they can sign that in March. So we'll see if that actually happens. But a lot of these countries are looking at this, the administration and saying, what happens if the Supreme Court rules against you? Where are you going to go with tariffs after that? The administration has said it's going to use other authorities to immediately impose tariffs, but the uncertainty about those will just return. What level are they going to be? What sectors are they going to hit? And how broadly are they going to hit certain trading partners?
Well, let me follow with India, because this is a pretty significant development that they feel that they can host a signing agreement in March. India was one of those first countries that came to the White House to negotiate. Can you just give us an update on where we think they were able to bridge the gaps that have been delaying an agreement going into place?
Yeah, there's lots of sticking points. The main one being access to India's agricultural market for U.S. agricultural exporters. That has been one where the leadership in India wants to protect its domestic farmers, a huge constituency, and that has been for a long time the sticking point between the U.S. and India on trade, and it seems like that's continuing to be the barrier to getting a deal. But they sound confident most recently that it's coming together. These trade deals often take years. These are certainly running into the many months, but the U.S. and India feel like they can get it done in March.
All right, a potential Supreme Court decision at 10 a.m. Eastern we'll be watching. Thank you. Brendan Murray leads our trade coverage out of London. Now to other top stories trending on the terminal this morning. The UK swung to a record monthly budget surplus of £30.4 billion in January, driven by higher tax receipts. That's the UK's biggest budget surplus on record. This is welcome news for Chancellor Rachel Reeves ahead of next month's spring statement. U.S. and Chinese fighter jets briefly faced off above waters near the Korean peninsula this week. That's according to a Yonhap News report. The U.S. planes didn't enter China's air defense identification zone, but Beijing scrambled planes as they neared that region. The face-off marks a rare confrontation in that area between the two superpowers. And HSBC cuts 10% of its U.S.-based debt capital markets team. Sources say at least 6 people in New York were let go on Thursday. That includes 1 managing director and 2 directors. The bank unveiled a cost-cutting program last year. It reports earnings Wednesday next week. And coming up, asset manager Blue Owl finds buyers for its private loans to pay out investors. More on that next. This is Bloomberg. This is Bloomberg Brief. I'm Tyler Kendall in New York. Blue Owl is said to have sold its $1.4 billion portfolio of loans. This as the asset manager attempts to pay out investors in a fund that was hit with a wave of redemptions last year. For more, let's bring in Bloomberg's Silas Brown. So, Silas, Blue Owl found some liquidity here. Is this a good outcome for investors in the fund?
Yeah, I think it's a genuinely nuanced picture. In one respect, yes. I mean, the debt that they've managed to raise is at close to par. So, I mean, in terms of investor distributions, I mean that's a great result. But I think also it marks a sort of end to a rather chaotic period for the fund and for Blue Owl itself. And so I think the kind of by hook or by crook nature of the distribution is somewhat concerning to investors. But I think overall top line figure, reasonably good result for investors.
Well, how has this highlighted the risks confronting retail investors entering what's this fast-growing private credit market now worth $1.8 trillion?
Yeah, I think the theory is quite interesting here. As is kind of obvious, private credit is an illiquid asset class, and these vehicles create some degree of liquidity, mostly for retail investors. But obviously, it's not a great look if you get a big amount of investor withdrawals and you're going to have to gate. Not that Blue Owl did, by the way. But I think the general picture and the kind of the chattering classes in private credit, be they analysts or journalists, would kind of point to this difficulty for private credit if they do see waves of redemption requests and investor withdrawals. Are they going to have to gate funds? How are they going to mediate that liquidity mismatch? I think that's a challenge for the market going forward.
Silas, we also wanted to ask you about this Bloomberg News reporting that Bank of America is said to be committing $25 billion to private credit deals. I'm just wondering, based on the data, is there a potential for conflict here as the bank supports and will compete with these funds?
Yeah, I mean, Bank of America joins the private credit party. Look, I think banks have this perennial conflict on how to kind of confront private credit, because it's a competing asset class, and so it's taking a lot of business and lucrative fees away from them, and it's kind of quite similar to what they already do, which is underwrite and distribute transactions. So I mean, Bank of America joins a bunch of other high profile Wall Street banks like JP Morgan in kind of coming up with solutions, and I mean, they are quite similar to JP Morgan in that they've earmarked a portion of their own capital to compete. In terms of conflict, yes, I do think that's potentially an issue, but I mean, financial markets are fraught with all manner of different conflicts. So that's just a kind of another one to join the bucket list.
All right, a lot to watch. Bloomberg's Silas Brown. Silas, thank you so much. And coming up, NVIDIA is reportedly close to injecting $30 billion in OpenAI. More on that and a look at what else is making headlines in your front page news. That's next. This is Bloomberg. This is Bloomberg Brief. I'm Cayla Kendall in New York. Time now for your front page news. First up, on the Wall Street Journal, Christine Lagarde says she expects completing her mission as president of the ECB will take her until the end of the term. The statement comes amid speculation that she will resign early to allow the current French government to help pick her successor before next year's election. Next up, on the Washington Post, the Trump administration is proposing to spend $2 billion a year to replicate the WHO after the U.S. withdrew from it last year. The effort would recreate systems such as labs, data sharing networks, and rapid response systems. Public health experts say the effort would be costly and unlikely to match the WHO's reach. And on the Financial Times, NVIDIA and OpenAI nearing a $30 billion investment. This will replace the long-term $100 billion commitment agreed on by the companies last year. Bloomberg Intelligence tech analyst Max Bloxham joins with the latest. So, Matt, put this into context for us. How surprising is it to see a potential retreat from that initial agreement amid all the concerns about this circular structure?
Yeah, I mean, obviously, it was kind of flagged fairly early on that maybe that original deal wasn't progressing as planned because there wasn't really any kind of updates. So I think actually maybe to me what might be surprising here is the size of the renewed deal. So like $30 billion of investment. The original deal saw $10 billion of investment at various tranches, and actually they're kind of pulling forward essentially a lot of that investment. And I think that potentially reflects a couple of things going on. One is that OpenAI's appetite for money to build out data center capacity and build its AI business is voracious, and they need as much money as they can get their hands on. So having more money up front makes sense. I think the second, perhaps from an NVIDIA perspective, is that with OpenAI thinking about going public, maybe the kind of valuation of this company could continue to go up quite substantially over time. And so under the original deal, because the equity transfer was staged with each $10 billion of investment, maybe they kind of decided that sticking to that original deal would have left them with less of an equity investment over time than putting $30 billion up front. Yeah, I guess the short answer, we don't really know yet what the kind of full thinking is, but I think, to me at least, the fact they're going with $30 billion sooner is perhaps a little bit surprising, and perhaps a kind of confirmation of their confidence in the OpenAI partnership.
Well, can you shed a little bit of light on the intrigue part of this and how the companies are talking about each other, particularly the heads of those companies, Jensen Huang and Sam Altman?
Yeah, I think they're both talking about each other kind of very positively. I think certainly Sam Altman in India has sought to downplay the sense of any rift between the companies, and that they still anticipate NVIDIA being a very important partner, and they'll continue to be a very big customer of NVIDIA. Obviously, one of the issues there has been that OpenAI has been rumoured to be looking at developing its own AI accelerators, and they're looking to diversify their purchases away from NVIDIA to companies such as AMD and Broadcom. So I think there's a balance there, and I think certainly again from the NVIDIA side, they're also looking to kind of hedge their bets. Obviously, OpenAI is an incredibly strong player in the AI market, but we have also Anthropic and Gemini and other platforms out there, and so NVIDIA is also looking to kind of make sure that it balances its exposure across all of the players, because they don't really know for sure which one's going to turn out to be the long-term winner.
All right, Matt Bloxham of Bloomberg Intelligence, thanks so much for joining us this morning. And coming up, we'll push ahead to PCE with Cayla Seder of State Street. That's up next here on Bloomberg. It's 5:30 a.m. in New York City. Good morning. I'm Tyler Kendall in for Vonnie Quinn with your Bloomberg Brief. Let's get you set up for the day ahead. Oil down after rallying to a 6-month high as President Trump gives Iran 15 days to reach a deal. Blue Owl sells a $1.4 billion portfolio of loans to help pay out investors amid concerns around private credit risks. And markets await the latest PCE data and a possible Supreme Court ruling on President Trump's tariffs. All right, happy Friday. Let's take a look at the markets. Futures pointed higher after heightened geopolitical tensions pushed stocks down yesterday. S&P futures up 0.2%. NASDAQ 100 futures up 0.3%, and small caps pushing higher as well. Let's also check in on the bond market as we await this flurry of economic data here in the U.S. The GDP number, also that December PCE inflation report, delayed because of the U.S. government shutdown, meaning the last government shutdown, not the partial one that we're currently in. On the long end, the 30-year yield trading at 4.70 on the short end, the 2-year yield trading at 3.47, and that 10-year yield just above 407, not up even a basis point. For some stocks to watch this morning, we're going to head over to London and Abir Abu Omar for those details. Hey, Abir.
Good morning, Tyler. Let's start with the world's top mining company. Newmont is down a little bit this morning. Not a little bit. It's trimmed some of those losses from earlier, but it's down quite a bit this morning, 3% almost, and that's on the back of two things. So the quarterly results showed profit that was actually good yesterday, but one thing that the company pointed out was the fact that it's going to be churning out less gold this year on the back of a closure in one of its mines. So investors not looking favorably at that news, despite the solid outlook on profit. That's Newmont down 3% almost this morning. Moving on to Opendoor, this digital real estate company is benefiting quite a bit from earnings that it announced yesterday, up 18.6%, adding to those gains earlier in the pre-trade session this morning. This is one of those companies that has benefited from this AI hype that we've seen in the market. We have the winners and losers of the AI disruption. Opendoor has really repositioned itself to win from the AI hype. And then finally, Moncler already trading in Europe this morning, the biggest, or was the biggest percentage gainer in the stock 600 this morning, up 12.1%, trimming some of those gains, but it's on the back of solid earnings and strong Chinese demand. Tyler, back to you.
All right, Abir, thanks so much. We're now less than 3 hours away from the December PCE inflation report, and to go through it all, we're joined now by Stuart Paul of Bloomberg Economics for a preview. So, Stuart, let's get into this and what we're expecting, because we already got part of the picture, right, from the U.S. retail sales in December, which were on a whole pretty flat. So when we get this report tell me, what are you looking for when it comes to services spending? And we keep in mind whether or not consumers are rotating away from, say, tariff-impacted goods.
That's exactly the entire question in this report. We have all the inflation inputs from CPI and PPI. As you said, we got a lot of the spending picture from retail sales, where spending on goods was just absolutely dismal. When we look at services spending, it looks as though it was a bit more robust, particularly in food services and accommodations. And we're also seeing some of that bid show up in prices. So when we think about the rotation, not only are we seeing some additional substitution away from goods and towards services, we're even seeing some of that spending show up in additional inflation pressure for things like discretionary services, dining out, and even things like video streaming. People are willing to spend more on Disney Plus, given the fact that they're not going to buy a new DVD player. No one's buying a DVD player, but given the fact that they're not going to buy a new imported TV, for example.
I also have to get your thoughts on GDP, because you and the team at Bloomberg Economics are estimating 3% growth for the fourth quarter. But this was, of course, the quarter that was most strongly impacted by the longest government shutdown in U.S. history. What would growth have been like if there wasn't that shutdown? And what are you predicting for the first quarter as we see that reopening effect?
I think that the fourth quarter would have looked a lot like the third quarter, or closer to 4.5% growth had we not had the government shutdown. By our estimates, the government shutdown reduced economic activity by about $100 billion during the quarter. On an annualized basis, that shaves off about 1.3 percentage points from the growth pace that we're going to see in the fourth quarter. So again, a little bit of an unforced error, slowing down economic activity. Looking ahead to the first quarter, though, we expect to see basically all of that come back online. And a lot of it is showing up not just in government spending in the first quarter, tax refunds and other sort of stimulus programs, but we're also seeing a lot of investment enthusiasm, and that's going to help to buoy growth really throughout 2026.
Well, I'm glad that you brought up tax refunds, because it seems like this White House is really banking on the larger than normal refunds under the One Big Beautiful Bill for a GDP boost. But do we know, are consumers going to spend that money, or are they going to pay off their bills or save it?
It's a great question. Right now, the personal savings rate is super low at about 3.5%. That's about 3 percentage points below the pre-COVID norm. Folks not only accumulated and then completely ran down their savings, they drew down their savings, and they've been under saving for well over a year at this point. I would not be surprised to see consumers sock away some additional cash when they get their tax refunds. But given how stretched thin people are right now, just to keep up their spending habit, they might need to put some of that cash to work once they get those checks.
All right. Stuart Paul of Bloomberg Economics. Stuart, thanks so much, as always. Joining us now for more is Cayla Seder, macro multi-asset strategist at State Street. Cayla, thanks so much for being here. Let's just follow on the heels of what we were just discussing with Stuart. We're getting this flurry of economic data today. Can you just lay out to start what your base case is for Fed rate cuts this year, as we're gleaning a little bit more about the economic picture?
Absolutely, and thanks so much for having me today. I think the most important thing when it comes to the future path of Fed cuts is what's happening on the inflation front. Part of that is because we've seen a bit more stabilization on the labor market side of things. So focus then switches to, is inflation still sticky or not? And one thing that really stood out to me in the most recent CPI print was that we still see stickiness within that super core component of CPI. And so that's really saying that even though there's been less focus on goods, which makes sense, especially if we expect tariff prices to be passed through over time, but that shifts the focus to the service side. And the service spending is still pretty strong. And so I think what that means is that we're going to be on pause for a while moving forward in terms of Fed cuts.
Well, Cayla, I wanted to ask you about your most recent research note, where you're writing that, quote, although institutional investors are already overweight risky assets, it's clear they're content to add more exposure. To really change the narrative, we would need to see a rise in systemic risk that would catalyze a liquidity and eventually credit event. You're talking about how we would need to see this rise in systemic risk to change that narrative. But when we get news like Blue Owl yesterday halting redemptions, are there potential ripple effects here that could increase that systemic risk?
Absolutely. This is something that's really important to keep an eye on. I think when it comes to some of this risk, we have to think, A, is it just concentrated to the AI story? And if it is, where in that is it just software and concerns around disruption to that AI will have on certain parts of the market? Or is there a bigger story here? So there's a couple of things we've been looking at. One is when we think about or where we see measurements in rising credit risk, it's really been concentrated in that software space. And so what that tells us is that it's not really rising in places like semis, tech hardware, and that means that the AI story really isn't over just yet. We see this in our institutional data as well, because although institutional investors have really cut their positioning in software and are now underweight, they've been adding exposure to semis and tech hardware that were already overweight at the beginning of this year. So we still see comfort in the overall AI story. Now, what about overall, market risk? We still see signals that systemic risk is actually quite low. What is high is turbulence and volatility, and that's where some of the risk is coming from. On the systemic risk side, the next question though is, okay, is that going to change, and what would catalyze that to change? One thing we really keep an eye on that front is liquidity, and we still see a solid liquidity environment. We still see signs that liquidity is getting to where it needs to go, and capital and credit are still flowing through the overall economy. So that's a good sign. I would say, there are concerns out there on the credit front, but overall, the overall environment is still quite robust.
Well, if we stick with AI, and we know that the tech sector has been a cornerstone of U.S. exceptionalism, I'm wondering, do you see this evolution and the spread of AI impacting this, and more broadly, the relative attractiveness of U.S. assets to the rest of the world?
There has been this sell U.S. narrative over the past year. We haven't seen that too much. And I guess I caveat that with, we have seen increases in exposure to other equity markets. However, the U.S. is still the biggest overweight by far. And so I think that context is really important to keep in mind. What drives that is fundamentals and profitability and earnings. And we still see the strongest earnings growth coming out of the U.S. relative to the rest of the world. And that has a lot to do with this AI story and this tech story. Even though tech has really been hit this year, especially that software space, when we look at large cap tech fundamentals, we still see rising earnings expectation. We still see solid margins, and we still see really strong revenues. So on that front, I think this will still support this overall U.S. equity market moving forward.
Well, if we keep with the theme of our eyes abroad, we are watching very closely those escalating tensions between the U.S. and Iran. I'm wondering, Cayla, how do you hedge geopolitical risk right now?
Absolutely. That's something that is front and center. I think that's something that's a little bit more challenging to do at the moment, because there's just so much uncertainty around what that would look like and a lot of volatility on the geopolitical front. I think what makes most sense is, stick with those solid quality, high quality parts of the market. Additionally, when we look at some of the rotation or broadening out that we've seen within equity markets this year, we have seen a little bit of an increase in energy. Now, I would caveat that that's not a huge overweight. And also when we look at earnings expectations in that part of the market, that's not super solid. So if you are looking for more of a cyclical rotation, I really like more parts like industrials, where we've seen fundamentals start to improve as well. So, although there's a lot of geopolitical uncertainty out there, I think when it comes to asset allocation, sticking with high quality and sticking with parts of the market that have stronger fundamentals makes sense here, because there's a lot of volatility on the geopolitical side of things.
All right, Cayla Seder of State Street, thank you for joining this morning. And now to some other top stories trending on the terminal. HSBC cuts 10% of its U.S.-based debt capital markets team. Sources say at least 6 people in New York were let go on Thursday. That includes 1 managing director and 2 directors. The bank unveiled a cost-cutting program last year. It reports earnings Wednesday of next week. And shares of Ray-Ban maker EssilorLuxottica are on track for their worst week in almost 4 years. The slump is fueled by potential competition from Apple on smart glasses. Apple is planning to launch its own AI-powered eyewear in 2027. And President Trump is directing the release of documents related to aliens and UFOs. He accused former President Obama of giving away classified information when he discussed the idea of extraterrestrial life in a recent podcast appearance. The U.S. intelligence community released a report in 2021 detailing what it knew about unidentified flying objects that have been spotted by military pilots. The unclassified report contained few conclusive answers. And coming up, President Trump ramping up pressure on Iran with U.S. military stationing in the Middle East. Stick with us. This is Bloomberg.
What word have you not heard over the last 2 weeks? Affordability. Because I've won affordability.
President Trump declaring victory on the cost concerns that have become a focal point of the upcoming midterm elections after polls showed voters have soured on his economic policies. Joining us now for more from Washington is Jonathan Tamari of Bloomberg Government. So, John, just first off, is that true when it comes to cost concerns? And also, is this a shift for the White House that in the past few months has really been playing defense when it comes to the issue of affordability?
So, there's data that suggests that, yes, inflation is cooling down a bit, but it's certainly not the kind of feeling that you're hearing from voters or that we're seeing from voters in polls, the sense that all of a sudden things are fixed and that they feel good about their own economic situation. Most polls suggest people are still pretty anxious, still pretty upset with the way things are going. And so I do think this is different than what you might expect, where the White House has said, listen, we inherited a mess, we're making progress, but there's still work to do. He's basically telling voters, look, the problem is over, don't worry about it. We saw in the last administration that approach did not work for them. It's a tough thing to tell voters not to feel anxious when they do feel concerned about their own economic situation.
Well, John, we're waiting today on a potential Supreme Court decision, and I'm wondering what you're hearing, not how the court will decide, because there's no way of knowing that, but how the Trump administration would ultimately react if their broad-based IEEPA tariffs are struck down. Because when I'm in Washington, there seems to be this divide emerging. On one hand, some feel that this could be a viable off-ramp for an administration playing defense on these affordability issues, and tariffs are such a core of their economic agenda. But on the other hand, we've heard time and time again from U.S. officials that they have all these other federal authorities, those other tools in the toolkit to use to impose tariffs if they can't use IEEPA.
Yeah, I would be surprised if we saw President Trump just easily back down if they lose at the Supreme Court. This has been core to his political identity pretty much since he first started running, and certainly core to his second-term agenda. He does have some options. They're not necessarily as powerful or as immediate, but he could impose trade licensing fees. There are provisions within different existing laws, the Trade Act, the Trade Expansion Act, where he could reimpose tariffs or attempt to under those provisions, but they're a little more limited. There might be a time delay into how quickly he can impose those tariffs. There might be limits on how far he could go if the Supreme Court does strike down his power on this, but I don't think he'll just back away very easily, even if he does lose at the court.
John, from domestic to foreign policy, you cover Capitol Hill very closely. And as we have our eye towards the Middle East and whether or not the White House is going to take military action against Iran, I'm wondering how Congress has been approaching the possibility of that when we have seen in recent months, for example, some lawmakers push back about the president's foreign policy initiatives when they're not conferred with ahead of time.
Yeah, I mean, we have seen that, as you mentioned, in Venezuela and some other instances where some lawmakers did raise concerns, but we're not seeing that right now on the Iran issue in the same way. Democrats are certainly saying that Congress should be involved here, that any major military action should require approval by Congress. There's maybe one Republican, Thomas Massie, who's raised objections, also Senator Rand Paul, so more than one, but there's not been a big outcry from Capitol Hill. Some of the Republicans who raised concerns about past actions are saying they're okay right now on Iran. So as has happened throughout this presidency, Congress looks likely to just kind of sit back and allow him to do what he wants, at least initially, and then maybe react depending on kind of what things look like going forward.
All right. Jonathan Tamari covers all things politics for Bloomberg Government in Washington. John, thank you. And Blue Owl is said to have sold its $1.4 billion portfolio of loans as the asset manager attempts to pay out investors in a fund that was hit with a wave of redemptions last year. For more, we're going to welcome back Bloomberg's Silas Brown in London. So, Silas, we were talking about this earlier in the hour, but as Blue Owl finds this liquidity, can you talk about what the mixed picture might be here for investors?
Yeah, it's interesting because I think, if you look in a very narrow way, I think this is a reasonably good result for investors. I mean, they're getting payouts at close to par on a kind of legacy fund that had experienced a lot of challenges before, and a whole series of plans to kind of get investor capital back that have since fallen by the wayside. So I think in the kind of narrowest interpretation, I think this is a good result, and certainly many analysts think the same thing. I think where the challenge emerges is, firstly, it was a slightly chaotic conclusion to this episode, and then secondly, I think, and quite importantly, what it's exposing is a kind of vulnerability for private credit, a market that has touted itself as immune to risks like duration mismatches and liquidity mismatches. And I think this is a kind of warning shot in a way for the broader market about the trials and tribulations of having to distribute cash back to investors in a more febrile environment.
All right, Bloomberg Silas Brown, thank you so much. And coming up, a host of economic data and Fed Speak on deck. Your day ahead is next. This is Bloomberg. This is Bloomberg Brief. I'm Cayla Kendall in New York. Now look at what's ahead for today. First up, PCE, GDP, and personal income and spending all at 8:30 a.m. Eastern. That's followed by UMich sentiment survey at 10 a.m. Eastern and Fed Speak from Bostic and Logan throughout the day. Now let's take a check on some micro movers. Open Door extending post-earning gains after its revenue beat the street's estimate. We also have Grail plunging as the healthcare company's cancer screener failed to meet a key goal in a test done by the UK's National Health Service. And also Newmont Mining down as the miner sees a decline in gold output for the year. Shares down 2.83%. Let's also check in on the broader markets today. S&P futures pointed higher, up about 0.2%. The dollar right now looking pretty flat, and the 10-year trading at 4.06. That's it for Bloomberg Brief this morning. Surveillance is up ahead. I'm Cayla Kendall in for Vonnie Quinn, and this is Bloomberg.